Mobile World's financial report shows strong revenue growth, driven by their dominant market position in Vietnam's ICT retail sector. Their extensive network of stores, coupled with their aggressive online expansion, has allowed them to capture a significant share of both physical and digital sales. The company's ability to adapt to shifting consumer behavior, particularly the increasing demand for online shopping, is commendable. Their financials reflect healthy profit margins, robust cash flows, and manageable debt levels, all of which suggest that they are in a solid position to sustain growth.
Revenue growth is certainly a positive indicator, but we need to delve deeper into the sustainability of that growth. The ICT retail market in Vietnam is becoming increasingly competitive, with new players entering both the online and offline spaces. While Mobile World has done well to maintain its lead, this competition could start to compress margins, especially if they need to engage in price wars to retain market share. Additionally, their rapid expansion could lead to overextension, which might strain their operational efficiency and increase costs. Have you looked into how their cost structure has evolved in recent years, particularly in light of their expansion strategy?
Their cost structure has remained relatively stable, with some increases in operating expenses as expected due to expansion. However, they've managed to offset these costs by improving their inventory turnover and leveraging economies of scale. The company's focus on efficiency, such as optimizing their supply chain and using data analytics to better manage inventory, has helped keep costs in check. Furthermore, their diversified product offerings, including consumer electronics, home appliances, and now grocery through their Bach Hoa San stores, provide multiple revenue streams, which can help mitigate the risks associated with increased competition in the ICT segment.
Diversification is a strength, but it also presents challenges. Entering the grocery sector, with Bach Hoa San, for instance, introduces them to a completely different competitive environment with lower margins compared to electronics. The grocery market is cutthroat, and success depends heavily on volume, pricing strategies, and supply chain efficiency. It's a sector that requires significant capital investment and operational expertise that's quite different from ICT retail. While their initial foray has shown promise, there's a risk that this segment could dilute overall margins or lead to inefficiencies if not managed carefully. How confident are we in their ability to scale Bach Hoa San without compromising their core business?
Mobile World's management has been prudent in its approach to scaling Bach Hoa San, focusing on optimizing store formats and locations before aggressive expansion. Their strategy has been to target underserved areas where there's less competition, which has allowed them to gain a foothold without immediately entering into direct competition with larger grocery chains. Additionally, they've been leveraging their existing logistics and supply chain expertise from their ICT operations to support the grocery business, which should help them control costs and maintain margins. While it's a different market, their methodical approach suggests they're aware of the risks and are managing them accordingly.
That's a reasonable strategy, but the success of Bach Hoa San will ultimately hinge on how well they can scale and compete as they expand into more competitive urban markets. The urban grocery market is dominated by well-established players with strong brand loyalty and extensive distribution networks. Mobile World will need to invest heavily in marketing, store upgrades, and perhaps even price reductions to capture significant market share in these areas. These investments could strain their cash flow, particularly if the grocery segment takes longer than expected to become profitable. How is their current liquidity position, and do they have the financial flexibility to support this kind of expansion?
Their liquidity position is strong, supported by consistent cash flow generation from their ICT operations and a healthy balance sheet with manageable debt levels. They've also been proactive in securing financing at favorable terms, which gives them additional flexibility to fund expansion. The company's approach has been to reinvest profits from their core business into growth areas like Bach Hoa San, rather than relying heavily on external financing. This conservative financial management has helped them maintain a solid liquidity buffer, which should allow them to continue expanding without jeopardizing their financial stability. However, it's crucial that we keep monitoring their cash flow and capital allocation to ensure they don't overextend themselves.
That approach to financing is prudent, but we should also consider the macroeconomic environment. Vietnam's economy has been growing steadily, but it's still vulnerable to external shocks, such as global economic slowdowns or changes in trade policies that could impact consumer spending. If there's a downturn, consumer electronics and higher-end items, which are a significant part of Mobile World's product mix, could see reduced demand. This would put pressure on their revenue and cash flow, just as they're trying to scale the grocery business. How does Mobile World plan to mitigate these macroeconomic risks, and do they have contingency plans in place?
Mobile World has been diversifying its revenue streams to reduce reliance on any single product category or market segment. In addition to expanding into groceries, they've also been growing their services business, including repair services, extended warranties, and financial services like consumer loans and insurance. These higher margin services provide more stable revenue streams that are less sensitive to economic cycles. Additionally, they've built a flexible supply chain and inventory management system that allows them to quickly adjust to changes in consumer demand. While macroeconomic risks are always a concern, their diversified approach and operational flexibility should help cushion the impact of any downturn.
Diversification into services and financial products is a smart move, but it comes with its own set of risks, particularly regulatory risks. The financial services sector in Vietnam is subject to stringent regulations, and any missteps could lead to fines or restrictions that could hurt their business. Moreover, offering financial products like consumer loans and insurance exposes them to credit risk, especially in a market that's still developing its credit infrastructure. If there's an economic slowdown, default rates could rise, impacting their profitability. What measures are in place to manage these regulatory and credit risks? And how robust is their risk management framework?
Mobile World has implemented a rigorous risk management framework to address these challenges. They work closely with regulators to ensure compliance with all financial sector regulations, and they've established conservative lending practices to minimize credit risk. Their consumer loans, for example, are offered through partnerships with established financial institutions, which share the risk and help ensure that they're not overly exposed. Additionally, they've been investing in advanced analytics and credit scoring systems to better assess and manage credit risk. While these measures can't eliminate risk entirely, they do provide a solid foundation for managing the additional complexities that come with expanding into financial services.
Those are positive steps, but given the breadth of their operations and the rapid pace of their expansion, there's always the risk of something slipping through the cracks. It's critical that we continue to monitor all aspects of their business, from their core ICT retail operations to their newer ventures, to ensure that they're not taking on more risk than they can handle. I'd recommend a cautious approach, perhaps by setting specific performance benchmarks that Mobile World needs to meet before committing further resources to expansion. This way, we can better manage our investment and ensure it aligns with our risk tolerance.
Agreed. Setting clear benchmarks and maintaining close oversight will be key to managing our investment in Mobile World effectively. Their growth prospects are strong, but we need to balance that with a careful assessment of the risks involved. By staying vigilant and proactive in our monitoring, we can make informed decisions that maximize our returns while minimizing potential downsides.